break-even point. The break-even point for any bull call spread at expiration can be calculated in advance. Above the break-even point, you could expect a profit. Below this point, you could expect at least a partial loss, assuming that all options are worth their intrinsic values as they expire. A bull call spread is considered a moderately bullish strategy because your maximum profit potential is limited. The theoretical maximum profit for any bull call spread at expiration can be calculated in advance as the difference between strike prices, which is the spread's maximum value, minus the debit originally paid. This profit may be realized under one of two circumstances. 1. The spread can be sold for its maximum value. 2. Both calls are in the money, assignment is made on the short call, and the long call is exercised. The maximum loss for any bull call spread is always limited to debit paid for the spread, no matter how low the underlying stock drops in price. This will occur at expiration if underlying stock closes below the lower strike price, with both the long and the short option expiring out of the money with no value. If spread becomes far out of the money before expiration, it's possible for it to lose all market value, but it's also possible for underlying stock to reverse course and regain some value. So how do you profit from this position? First of all, if you close out or sell the spread before it expires for more than you paid for it, your profit will be the difference between what you paid to establish the position and what you received for selling. For example, suppose XYZ stock has increased in price and you find these prices in the marketplace. XYZ June 50 call at $7.50. XYZ June 55 call at $4. Closing out. To close out your long spread, you buy the short 55 call for the current price of $4 and sell the long 50 call for the current price of $7.50 for a net credit of $7.50 minus $4 equals $3.50. The total cash you'll receive from the spread sale is the $3.50 credit times 100 shares, $350. Since you originally paid $200, your profit will be the difference, or $150. As any bull call spread is moderately bullish in nature, an increase in the underlying stock price could be expected for profits to occur. At expiration, if both options are in the money, trading at their intrinsic values, and the spread can be sold for its maximum value, you realize the maximum profit. This situation could occur if the underlying stock closes at any point above the short or higher strike price. This maximum profit is theoretical because it assumes that the spread can in fact be sold for its maximum value. In reality, you may only be able to sell the spread for somewhat less. Why? Would you or anyone else want to buy a spread for its maximum value if it had no profit potential for its remaining lifetime? The impact of timing. What about before expiration? You may find that a bull call spread may theoretically be worth its maximum value before expiration if both calls are deep in the money and are trading for their intrinsic values. If your initial objective was to sell the spread for a profit, whether before or at expiration, then you might do so whenever you can receive its maximum value or the difference between the strike prices. If it looks as if a bull call spread is going to expire in the money, that is, with the stock price above the higher strike price, then you might choose to let the exercise and assignment process generate the maximum profit. If you are assigned on the short call, you can exercise the long call, buy shares at the lower strike price, and then sell those shares at the higher strike price. Finding net profit. You'll receive a gross profit per share equal to the difference in the strike prices. However, because you paid a debit for the spread, your net profit would reflect the formula for maximum profit, which is the difference between strikes minus the debit paid to establish the position. Note that early assignment on the short call of any bull call spread can result in the maximum profit as well. With the June 50-55 call spread, you could be assigned and sell 100 shares at 55, exercise and buy 100 shares at 50. Receive the $500 difference less $200 debit for a maximum profit of $300. Pin risk. Pin risk is the possibility of the stock closing at exactly the short strike price at expiration. If this seems likely, you may want to consider these alternatives. Exercise the long call. Exercise the long call and close out. Sell the spread. At expiration, a bull call spread may be partially in the money. That is, the underlying stock closes between the spread strike prices so that only the call with the lower strike is in the money. In this case, if you're comfortable that the call with the higher strike will expire out of the money and unexercised, and you're willing to assume the risk of this naked short position, you might sell the long call for its market value. If you could sell for more than the debit paid for the whole spread, you'll see an overall profit for the position. If you sell it for less than the spread's debit, then you'll see only a partial loss. However, you may find that your brokerage firm will not allow you to carry an uncovered short position. We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.optiontradersnetwork.com. Thanks so much.